Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
We've got some important updates in the world of finance and credit markets.
That's right, Vijendra. First up, Credit Access Grameen has successfully raised 425 crores through a private placement of non-convertible debentures, a significant move for the company. And lastly, Som Distillery's ratings have been downgraded following the suspension of operations at their Bhopal plant. We'll be digging into what this means for the company and the sector.
On a different note, VIP Industries has seen its credit rating downgraded to CRISIL A- with a negative outlook. This signals some concerns ahead for investors. Credit Access Grameen raised Rs 425 crores through a private placement of non-convertible debentures. The first tranche was Rs 325 crores at a fixed coupon of 9.25% per annum for 2 years, including a green shoe option showing strong demand.
This shows strong market confidence, especially with institutional investors like Sundaram Finance involved. The mix of fixed and floating rates helps diversify their funding, enhancing financial resilience amid competitive microfinance lending.
The second tranche was Rs 100 crores placed bilaterally with Bajaj Finance at a floating coupon of 9.15% per annum for 2 years. This aligns with their strategy to build a cost-efficient, diversified funding base by 2028.
Given their extensive footprint across 16 states and 1 union territory, this capital raise strengthens their balance sheet. Investors should watch how this impacts their cost of funds and asset quality going forward.
Here's another significant update. CRISIL downgraded VIP Industries' long-term rating from AAA with negative outlook to A- with negative outlook. This affects bank loan facilities totaling Rs 464 crores, reflecting weaker financial health and increasing credit risk. The downgrade stems from operational and financial struggles in recent periods. CRISIL's concerns highlight a need for VIP Industries to improve performance to avoid further rating erosion and maintain competitiveness in the consumer durable sector.
This downgrade signals tougher borrowing conditions for VIP Industries. The negative outlook means further downgrades are possible without financial improvement, which could tighten funding options and raise costs amid market challenges. Investors should watch upcoming financial results closely. VIP Industries' ability to address CRISIL's issues will be crucial for stabilizing creditworthiness and securing favorable funding amid ongoing market pressures.
Now, let's discuss another important development. Infomerics Ratings downgraded some distilleries and breweries' long-term rating from BBB+ to BBB and the short-term rating from A2 to A3+ due to the temporary shutdown of their Bhopal plant impacting revenue.
This downgrade signals increased financial risk, likely raising borrowing costs and making lenders wary as the plant suspension threatens stable cash flows and debt servicing ability.
The critical factor now is when the Bhopal plant resumes operations. Prolonged suspension could worsen their credit profile and financial health.
Investors should watch for official updates and Infomerics' future commentary to gauge recovery prospects and potential rating revisions.
Let's look at another key development. Utkarsh Small Finance Bank is selling stressed loans totaling Rs 726.83 crores using the Swiss challenge method, dividing assets into 3 pools: unsecured microfinance loans of Rs 507.42 crores and Rs 143.12 crores, plus secured commercial vehicle loans of Rs 76.29 crores.
This method encourages competitive bids from asset reconstruction companies by using an existing offer as a benchmark, aiming to maximize recovery and improve the bank's asset quality by offloading non-performing assets.
The bids close at 5 p.m. on June 29, 2026, and the sale is on an as-is, where-is without recourse basis, meaning the bank won't bear losses post-sale, which is crucial for risk containment.
Market watchers should focus on the final recovery amount, as it might be lower than the principal outstanding, impacting profitability and signaling the bank's effectiveness in managing stressed assets.
Let's look at another key development. Kamdenu Limited's issuer rating was upgraded from CARE A stable to CARE A+, stable by CARE Ratings, reflecting improved operational efficiency and fiscal year 2026 financials.
This upgrade enhances Kamdenu Limited's credit profile, lowering borrowing costs and increasing lender confidence, especially important in the steel and TMT bar sector.
The improved rating suggests stronger execution and business stability, giving Kamdenu Limited a competitive advantage over peers with lower ratings.
Still, investors should watch ongoing financial results and market conditions, as future changes might impact the rating despite this positive outlook.
Here is another significant update. IIFL Finance has board approval to raise up to Rs 10,000 crores via equity or other securities, possibly in multiple tranches. Methods include public or rights issues, private placements, or qualified institutional placements depending on market conditions.
This flexible approach allows IFL Finance to optimize capital raising based on demand and regulatory approvals, enhancing their ability to meet growth and liquidity needs efficiently.
Additionally, the company doubled its global medium-term notes program limit from 1 billion to 2 billion US dollars and raised domestic borrowing and security limits from rupees 60,000 crores to rupees 75,000 crores.
These increases strengthen IIFL Finance's funding flexibility, enabling better access to both domestic and international debt markets, which is crucial for NBFCs in a competitive lending environment.
Let's move on to our next article. Anchor investors like Ares Management and Deutsche Bank have agreed to extend the loan-to-value ratio relaxation for Shapoorji Pallonji bonds until September 30th. This move supports a refinancing plan aiming to raise rupees 22,000 crores led by Deutsche Bank, marking one of India's largest private refinancing deals. This extension is crucial given the previous LTV increase from 34 to 40%. Market confidence has improved after the Reserve Bank of India clarified regulations for non-bank financial companies, boosting hopes for a Tata Sons public listing, though no dates are confirmed yet.
Additionally, Goswami Infratech bondholders extended maturities by 1 month to July 31st with a consent fee of 30 basis points. Investors focused mainly on LTV covenant clarity without formal commitments on Tata Sons stake monetization or deleveraging plans. These approvals indicate cautious investor support, balancing risk with potential value from Tata Sons. The refinancing and extensions collectively help the group manage upcoming debt while maintaining investor trust amid regulatory shifts.